students. Today we are discussing about the methods of credit control used by RBI. Basically, this is about how we can control, how RBI controls the money supply into the market. Basically, this we have already studied in your economics part. Here, there are two methods to control over the credit or money supply. There are basically two methods. One is quantitative or journal methods. On second part, it is qualitative or selective methods. In quantitative methods, there are four methods. One is bank rate, second is open market operations, third is cash reserve ratio. In fourth method is statutory liquidity ratio. When we are talking about selective or qualitative methods, where we are seeking the quality of the loans or other securities. So here we are providing the various six methods. Number one is credit rationing, number two is margin requirement, number three is regulation of consumer credit, number four is moral persuasion, fifth is direct action, the last one is method of publicity. So the first one is bank rate under a quantitative technique. That is, the bank rate is the rate at which the central bank of the country is prepared the rediscount the first class securities. Here the first class securities stands for the securities which can easily be sold in the market, and we can realize the cash. So it means the bank is prepared to advance loans on approved securities to its member banks. As the central bank is only the lender of last resort, the bank rate is normally higher than the market rate. A fall in the bank rate makes the credit cheaper, increase the volume of the credit, encourage the businessman to borrow and invest, and increase the level of economic activity and the price level. Here we can discuss how we can control over the credit. A fall in the bank rate makes the credit cheaper. If there is a credit which is available at a cheaper rate, then that will increase in the volume of credit, means that will encourage the businessman to take the loan from the bank, and they will take loan from the bank and invest somewhere, and this will increase the level of economic activity and price level. And the next one is open market operations. Basically, open market operations stands for when RBI buy or sell securities. So in narrow sense, the central bank starts the purchase and sale of government securities in the money market. In the broader sense, the central bank purchase and sale not only government securities but also of the other proper and eligible securities like bills and securities of private concerns. When the banks and the private individual purchase these securities, they have to make payments for their these securities to central bank. When when RBI want to reduce the level of the credit, they basically, you can say, they want to reduce the level of the credit, then they will sell the securities in the market, and people buy that securities, or banks buy that securities, by which RBI collect the money from the market. So that control over the credit. And the vice versa, when they want to expand the credit, they will buy the securities from the market, and the cash should be released, credit should be released in the market, money supply should be increased in the market. The third one is cash reserve ratio. Cash reserve ratio, we all know that that is a minimum cash requirement. As a commercial bank, we have to deposit it with the RBI as a security. So we can study the cash reserve ratio refers to the proportion of aggregate deposits which the commercial bank are required to keep with the RBI. The central bank control credit by changing the cash reserve ratio from time to time. For example, if the commercial bank have excessive cash reserves on basis of which they are creating too much of credit, which is harmful for the larger investment of the economy, so RBI will raise the cash reserve ratio. So if the cash reserve ratio should be increased, for example, if one bank is having a time and demand deposits of rupees, say 1 crore rupees, and if the RBI increases, uh, you can say, cash reserve ratio by 1%, which means if we can take a 1% of 1 crore, which is equal to 1 lakh rupees, so that they will give 1% less credit to the market. So that control over the credit means increase in the cash reserve ratio will control over the money supply, and decrease in the cash reserve ratio will expand the credit in the market. Same like statutory liquidity ratio. Here we have to maintain some ratio or percentage of time and demand deposits with ourselves as a commercial bank. So here the statutory liquidity ratio is, again, if RBI increase the statutory liquidity ratio reserve, then that means they will control over the credit. If they will decrease that statutory liquidity ratio, same as a cash reserve ratio, they will expand the credit in the market. So the first qualitative or selective technique for the credit control is credit rationing. Rationing of the credit is the method by which the central bank seeks to limit maximum amount of loan and advances in certain cases, fixing the ceiling of specific categories of loan. For example, if I'm talking about ceiling is basically the higher limit, maximum limit. So basically, when we are talking about here credit rationing, for example, if I'm taking a loan on house, for example, the house is having a value of rupees 1 lakh, they will fix a limit that is 80%. We can take 80% of 1 lakh rupees of the registry amount. So we can take only 80,000 rupees as a loan, right? So credit rationing is basically fixing the maximum limit of loan on the registry value. So if we can lower down the value, that will control over the credit. For example, if from 80% they will decrease to 75%, that will decrease the amount of credit in the market. And on the vice versa, if they will increase the credit rationing rate, means maximum ceiling rate, then that will increase the credit. Next is margin requirement. Again, from the last point, if I'm talking about the margin requirement is basically a difference between the actual value, market value, and the loan amount. So what is the difference? Basically, if I'm taking a loan on 1 lakh rupees property as rupees 80,000 as a 80% credit rationing ratio, that means there is a 20% margin. If the value is, if the value of market value has been increased, then we can take more loan. So margin requirement is basically influence the flow of credit. Basically, when we are talking about a margin requirement, that should be followed while we are taking a loan against a gold. For example, gold loan, when the prices of gold are increasing and decreasing, then we are following the margin requirement, and that should also follow in share market. Next is regulation of consumer credit. Consumer credits are basically followed. This method was the first used in USA in 1941. Here we can regulate the terms and conditions of consumer credit when we are buying some consumer goods such as air conditioner, refrigerator, washing machine, and other goods, household goods, on which we can take a credit. Earlier it was less than 1 year, but nowadays it may be a greater than 1 year. So here we have to fix some you can say regulation for the consumer credit. For example, if I want to buy a air conditioner for rupees 40,000 rupees, and if I want to take a loan against that AC, I will take 100% loan, but there are some rules and regulation. I have to pay that 40,000 rupees in 8 installments, 12 installments, 18 installments, or maybe some other condition like 8 plus 4. 8 plus 4 technique is we have to pay 8 installments, and 4 installments I have to pay at the time of down payment, means at the time of purchase. So there are some regulations of consumer credit which can control over the credit in the market. Next is moral persuasion. This method is frequently adopted by the central bank to exercise the control over the commercial banks. Under this method, central bank give advice, then request and persuasion to the commercial bank and to cooperate with the central bank is implementing its credit policy. Like they are basically given the monetary policy, RBI given the monetary policy. So every bank has to follow the same policy for the moral persuasion, or we can say credit control regulations or credit policy. So if the commercial bank do not follow and do not abide by the advice of or request of the central bank, no gross action is taken against them. The central bank merely with the moral influence and pressure with commercial bank to prevail upon them to accept and follow the policy. Next is direct action. Under this method, if the commercial bank do not follow the policy of the central bank, then central bank has the only recourse of direct action. They can directly take action on the commercial banks. This method can be used to enforce both quantitatively and qualitatively credit control by the central bank. This method is not used in isolation. It is used as a supplement to the other methods of credit control. That method cannot be used as a single. They can be taken with any of the previous methods we have followed. Next is method of publicity. Method of publicity, as publicity we know that that is a promotional technique we can promote in the public. In modern times, central bank in order to make their policy successful take the course of medium of publicity. A policy can be effectively successful only when an effective public opinion is created in its favor. So basically they can show the credit policy on the newspapers, on the, you can say, news channels or other medias through which they can publicize the same thing. So this is the method of publicity by which we can control over the credit or we can expand the credit. So through publicity, the central bank seeks to influence the credit policy to the commercial banks, to educate people regarding the economic and monetary conditions of the country, to influence the public opinion in favor of its monetary policy. So these are the methods of credit control. One are the quantitative, another are qualitative. Thank you so much for listening. If you have any query, then you can text me personally. Thank you.